Welcome to Basics of Digital Assets, Module 3, Investing in Crypto. This is the third module of a series of HashKey Academy videos. So if you didn't check the other videos, please go and check the Module 1 and Module 2. My name is Henrique. I work as a Senior Research Manager for HashKey Capital, and I will be your instructor. All right, so let's start the Module 3, Investing in Crypto. We are going to discuss some very interesting topics, including what to consider before investing, the pros and cons of investing in crypto, where to buy crypto, centralized exchanges versus decentralized exchanges, technical and fundamental analysis, which crypto should I invest in, brokerage services and OTC trading, what type of investor are you, risks versus volatility, and how to diversify your portfolio. So without further ado, let's get into it. What should you consider before investing in crypto? First, you need to have into account that crypto and blockchain is a relatively new technology. Considering it's a new technology, it's also a volatile and high-risk investment. Most cryptocurrencies are not FDIC insured. If you have a deposit in a bank account, these are FDIC insured. If the bank goes bankrupt, your deposit is secure. But if you have cryptocurrency in an exchange and the exchange goes bankrupt, you may eventually lose part of all your funds. You need to understand and get familiar with the mechanisms of buying, selling, and exchanging crypto before investing. Make sure that you start with small amounts in order to get more familiar with these mechanisms. Also, always do your own research before investing. You should look at the product that this project is offering. Who is the team? Is the team qualified? And do they have a track record? How big is the community around the project? What are the potential network effects? What's the revenue model of this project? The technology? Who are the other investors? Do they have, for example, venture capital firms investing in the project? And do they have liquidity? And of course, always compare the roadmap with the developer activity to see if the developers are actually executing the roadmap or not. Always make sure that your portfolio is diversified across different asset classes. And crypto should only be a small percentage of your total portfolio. And within your crypto portfolio, you should also diversify across different cryptocurrencies and include also some of the major cryptocurrencies in order to lower the risk of your portfolio and maximize the upside. Resist also the fear of missing out. So always do your own research and never jump into an investment without properly understanding what it is about. And remember that cryptocurrency may be a taxable event in many countries. Some of the pros of investing in crypto are the fact that crypto is a 24/7 market with usually good liquidity, unless of course you are thinking about high volumes. The potential upside is big, and it can potentially help investors to beat inflation. It's usually independent from centralized authorities, and it's pseudo-anonymous and transparent. What are some of the downsides of investing in crypto? Well, because it's still a very recent technology, understanding the crypto market takes time and effort. Also, the crypto market is sometimes a very volatile investment. It may have scalability issues, meaning that it may have issues to grow. It may have security risks, especially if you don't keep your wallet secure. And in many cases, it's not formally regulated by central governments. Now that you know the pros and cons of investing in crypto, let's learn where can you buy crypto. The first example are centralized exchanges. Examples of centralized exchanges are Binance, Coinbase, FTX, KuCoin. In this case, the third party, the centralized exchange, will keep control over your wallet, over the private keys. And they will also be responsible for the security of your wallet. In this case, it will also be required KYC, Know Your Customer, and identity checks. Then you have also decentralized exchanges like Uniswap, SushiSwap, DYDX, and 0x. In these cases, you control the private keys of your own wallet and you interact with the decentralized exchange directly. No personal data is required, but you are responsible to keeping the security of your wallet. Some wallets, like Exodus, MetaMask, Trust Wallet, and HashKey will also allow you to buy crypto directly from the wallet. And finally, in certain cities around the world, you will also be able to find Bitcoin ATM machines. In the previous slide, you saw that you can buy crypto from centralized exchanges and decentralized exchanges. What are the main differences? Well, centralized exchanges are usually custodial, meaning that they will keep the control over your wallet. They usually offer high liquidity and easy on-ramping, meaning that it's easy to exchange to fiat currency. KYC and identity checks are needed, and the security is responsibility of the third party, responsibility of the exchange. In terms of options, there are usually less options to invest. On the other hand, decentralized exchanges are non-custodial, meaning that you keep full control and also full responsibility over the private keys in your wallet. The liquidity is usually lower. There is no possibility of exchanging it to fiat currency. Identity checks are not required. The keys and the security are your responsibility, and it offers usually a wider range of tokens and cryptocurrencies to choose from. Let's now compare technical and fundamental analysis. Starting with technical analysis, what it does is that it focuses on the asset historical performance. However, you need to remember that historical performance is not a guarantee of future performance. Technical analysis usually looks at the historical price in order to try to predict patterns for the future price of an asset. It examines also the trading volume, market capitalization, volume, and some indicators like trend lines, moving averages, MACD, RSI, and many other indicators to try to understand what's the market sentiment, what's going to be the future trends of these assets. While the technical analysis looks at the past to try to predict the future, fundamental analysis looks at the present to try to understand the big picture and future price action of an asset. Fundamental analysis will look at macroeconomics, who is the founding team, the community, the network activity, the roadmap, the potential for real-world applications, intrinsic value of the project, cash flows, revenue, and other more concrete things that will give you clues of the future of these assets. To invest smartly and safely, always remember to evaluate the project first. You should look at multiple quantitative and qualitative factors, including the team, the white paper and roadmap of the project, fundamentals of the project, tokenomics, circulating supply, total and maximum supply, the market capitalization, and trading volumes. Brokerage services and OTC trading. A cryptocurrency broker provides online financial services for users who want to buy or sell cryptocurrencies. Unlike exchanges, using a brokerage is more suitable variant for higher amounts of money due to several reasons, such as security and better liquidity. After depositing your collateral, you have various trading opportunities, including leverage positions, depending on the services provided by the specific broker. OTC trading are private deals for buying or selling crypto. The biggest appeal for OTC users is the privacy and low impact it has on market prices. Although accessible to everyone, OTC caters to whales who are looking to buy or sell large amounts of cryptocurrency. If these whales choose to purchase a large sum of crypto on an exchange, their transaction will be heavily impacted by slippage, which makes OTC trading a desirable option for high net worth individuals looking to make large trades. What kind of investor are you? Depending on your investment profile, you may need to adjust your investment strategy and risk appetite. Are you a beginner, a hodler? Are you a trader, an early adopter? Are you an institutional investor or a family office? What's your risk profile? Before starting investing, you should always assess your risk profile, understand your risk appetite, and according to that, adopt a proper investment strategy. Before investing, you should always be aware of the potential risks and volatile nature of the cryptocurrency market. Cryptocurrencies are volatile. Unexpected changes in market sentiment can lead to sharp and sudden price. They are susceptible to error and hacking. There is no perfect way to prevent technical glitches, human error, and hacking. And also, they can be affected by forks or discontinuation. Cryptocurrency trading carries additional risks such as hard forks and discontinuation. Market risk and volatility are not the same. Volatility can sometimes even be seen as a good thing. Volatility is one of the factors driving the crypto markets, while the intensity and volatility spread are higher in the crypto space when compared to traditional markets. Market volatility can be measured through the Crypto Volatility Index, CVI, while market risk cannot. CVI is a decentralized VIX for crypto that allows users to hedge themselves against market volatility and impermanent loss. What's the Fear and Greed Index? The Fear and Greed Index represents the emotions and market sentiment of Bitcoin and other large cryptocurrencies. The Fear and Greed Index is composed of volatility, market momentum and volume, social media, dominance, and Google Trends. Usually, values closer to 0 represent extreme fear, and values close to 100 represent extreme greed. Typically, this can be also seen as a buy and sell indicator, being extreme fear a buy indicator and extreme greed an indicator that probably you should take some profits. Finally, the last but not the least, diversify your portfolio. Having a well-diversified portfolio is one of the best ways to limit risk. You can buy cryptocurrencies with different use cases, invest in different cryptocurrency blockchains, diversify by market capitalization, diversify crypto projects by location, invest in different industries, branch out to different asset classes, and diversify by risk level.